Hi, let's kick off now. So, good morning again, and welcome to Saxo's weekly market outlook call. I am Charu Chanana. I'm a market strategist with Saxo Singapore, and I'm joined today by my colleague Redmond Wong from our Saxo Hong Kong office. After the crazy run of key events that we had in the last week, it is starting to look a lot more Christmassy as markets start to get quieter. Hopefully we should be able to get over with this call today quite quickly. I hope so. So I think just starting off with that key CPI print that we had in the US last week, once again confirming that goods inflation in the US is slowing down, but still services inflation remains quite high, and that's key because it's 60% of the CPI and it's very sticky. So I think that will be the key measure that will continue to constrain the Fed from that pivot that really the markets have been waiting for. Anyway, despite that softer CPI, markets ended the week lower by over 2%. And that was because the Fed gave us a very hawkish message with an upward shift in its dot plot, bringing the terminal rate projections to 5.1%, which was higher than what was in the expectations. And of course, it was higher than what we had seen in the September dot plot as well. And despite that increase in terminal rate expectations, we also still got higher inflation forecasts for next year from the Fed. So just kind of signaling how difficult it is remaining for the Fed to bring that inflation under control. And not just the Fed, we also had some of the other central banks, the G10 central banks, out with a very coherent hawkish message, especially the ECB, the European Central Bank, which hiked by 50 basis points as well, like all of the other central bank meetings we had last week from the G10 countries. But Lagarde remained committed to further tightening, a lot more than what we saw from some of the other banks. And also they announced the start of a quantitative tightening in the first quarter of 2023. But again, I mean, that does raise some concern on peripheral spreads in Europe. So again, you could quite be, difficult to expect the ECB to stick to that kind of a hawkishness going forward as well. And that realization is making euro dollar, go back lower. It's giving up the 1.06 handle now. So that will be important to watch this week as well, how that develops. I mean, anyway, this week doesn't bring a lot. We have the US PCE data, which is the measure of inflation that the Fed watches. But it will be, again, the continuation of that old story where you have a possibly softer print, but not enough to expect a Fed pivot, or even at the stage, it's not even enough to really confirm a further slowdown in, the Fed's tightening path, at least for February. I mean, we can't really confirm that we will downshift to 25 basis points in the February meeting. So I think it'll be a very non-event kind of an update. Nothing else really due of note from the US this week. So maybe I'll pause here. And I think a bigger focus, at least for Asia, will remain on how this China reopening has been playing out, especially with the number of cases rising rapidly, in most of the key cities. So let me pass over to Redmond to discuss a little bit more on that.
Hi, morning everyone. Just before I move on to China, just I would add a little bit on the U.S. situation. I think the bond market, especially the money market curve, is more like calling bluff of the Fed, and because the 2-year yield at 4.18. And now in Asia now it will high at 4.20, and last Friday was 4.18, and that was below the 3-month T-bills yield, and also below the Fed fund. And it rarely happened in the past, and unless the market is pricing in actually the Fed, the next move from the Fed is a pause or even rate is a ease, and so that is actually a tough war between what the hawkish message from the Fed, Charu just mentioned, especially on Friday, and also Powell's comment, and also what the Treasury market, the short end of the Treasury market is pricing in, and the Treasury market is pretty much is a doubt whether the Fed can actually deliver as what the hawkish remark they have said, and Yes, and the attention also a lot in China, quite a lot of things happening. And last week, I think one of the actually there's a few positive development, but also there's some negative. And the first positive one is the U.S. accounting regulatory body basically gave a pass report for those audit work paper from two auditors and then related to 8 Chinese company and which listed in the US. And so that basically removed the risk of delisting and for the time being of those Chinese ADR. So that's one positive. And the other one is that we had the Central Economic Work Conference that took place on Thursday and Friday and concluded on Friday, and then and then in the evening after market close at the news, they have a readout and a statement and summarizing the key point, a few things, and okay. I think, of course, its fiscal policy will continue to be expansionary, and monetary will also be forceful and precise. And but because of the tune that is more like focused, the top priority, they reiterate in the readout saying that it's really stability, and also give a sense that actually it's more like a best effort basis on the growth target, and so more or less it's good to see that is have a pro growth kind of a tune, but at the same time, its stability is still the number one. So they emphasize basically there will be no massive monetary stimulus, and there will be more forceful. There will be more to come, but not just but not as kind of not using their term. They are not going to flood the street with a lot of money. So and then, but the more positive, more encouraging things is really on the attitude towards the private sector. And because it's in last year's in this important annual Central Economic Work Conference, and they say is actually they put a high priority to prevent the disorderly expansion of private capital. And this statement was omitted and removed from this year's readout. And instead, and actually it pledged to support the private sector and private enterprises, and saying that so remove and to avoid those unfair treatment towards the private enterprises. Of course, they also reiterate, say that okay, the state-owned enterprises have to be the very important and so on. But at least they said the policy and the implementation or execution of policy have to make sure that they don't treat private enterprise unfairly. And even more encouraging, it also pledged to support the platform economy, platform enterprises, i.e. those is China Internet e-commerce company, and to compete to succeed in the competition globally, and also to develop and also create employment. So that is so these two actually, I think, from the more regulatory environment is more favorable. And so I think that probably I would say that is the key positive from this meeting. About property market, of course, many people are also watching what the Chinese Communist Party say about, and Chinese government say about the property sector. Basically, it say okay, it support and the those demand, reasonable demand for housing, and it press certain support to the real estate sector, the housing sector. But at the same time, it put back the statement: housing is for living in, not for speculation. So this statement actually has always been there, but that was omitted in the Politburo meeting readout last week, the week before, and so that but it was back into the readout of the Central Economic Work Conference. So what that means basically is saying that there will be a support to the public sector to make sure there will be no systematic risk there. but at the same time, the government is also still mindful of stirring up a lot of speculation in property prices later on. But at the moment, of course, is that he also mentioned some credit support and so on to quality developer and so on. So all in all, the whole meeting giving us is more like a stability, steady growth, and especially a more conciliatory, more friendly to private enterprises. Overall, is a positive we consider should be helpful to internet stock and the market overall. And then is that so after this positive news, of course, we also have some negative from social media, from newswire report, and also from TV. And we know that is that is after the lifting the lockdown and the restriction, the cases are surging in China, many cities of COVID infection, and that remind me more like Hong Kong earlier this year when in March, April, and you saw hospital have a long queue and people rush to buy Panadol and all those stockpile all kind of medicines, and death tolls reportedly has gone up, and I think that's pretty much expected when China is exiting from the lockdown so abruptly, and that will be the infection, the cases will research, and I think investor will monitor it very closely and see whether the Chinese government will roll back some of those with easing. And so far, I mean, it's the Shanghai saying that okay, some of the school, especially kindergarten and primary school, and will start holiday early and so on. But I think given the way all those what we read from from other official sources, and also from the way I think I think that the Chinese leadership's way of doing things. I think that the possibility, the probabilities basically they will continue and carry on this relaxation of COVID restriction despite the challenges, and we don't expect that they will reverse course anytime on that, and seems is I think that is pretty much is irreversible, and I think they have to continue. But anyway, it's something we need to watch very carefully, and whether even though the government does not reimpose those restrictions, and whether the people actually they are afraid of being infected and not willing to go to work and so on. There's something I think we need to watch. But so far we think that relaxation of credit policy will continue despite the surge in this initial surge in cases. Yeah, I think that's all for me, and Charu, I'll pass it back to you.
Thank you, Redmond. Yeah, so despite these short-term headwinds because of the rise in number of cases in China, I think the long-term story, at least into 2023 second half, probably looks quite promising because of the authorities' commitment towards reopening, the authorities' commitment towards supporting the property sector. So, of course, I mean, if clients want to really take some positions in China, I think obviously get in touch with your relationship managers or sales traders, and there's consumer tech ETFs to consider. There's energy transition, which is a big story in China, and will probably gain a lot more traction into the next year as well, we think. So probably that will be interesting. But just switching gears here, so we also have the Bank of Japan meeting this week. Important to watch to see if we do get any hints of a policy review there. So there's been a lot of mixed chatter around that over the last few weeks from officials, and then over the weekend we had Prime Minister Kishida also hinting that he could consider working with the BOJ in altering the 2% inflation goal that the central bank has, and try to make it a little bit more flexible after we see the new governor step in with Kuroda retiring in March, April 2023. So any further news on that continues to set some expectations that the Bank of Japan would be considering changing its yield curve control policy next year. And obviously the positioning in yen has been so weak after the run higher in US yields this year that it is a big mover for the Japanese yen potentially. We also have inflation for November coming out from Japan this week, and although that comes after the BOJ meeting, but again, very key to watch with the headline getting close to that 4% level. So inflationary pressures are meaningful. Whether these turn into wage pressures or not will be key to watch into the next year. We also have wage negotiations due in March, just before Kuroda retires. So all those events are lining up, and I think speculation is building in. So it's important to consider that again, the potential for a recovery in the yen is massive. Also, I mean, if we do continue to see that uptick with Saxo's global inflation view being higher for longer because of supply chain issues, because of green transformation, climate change, China reopening, and the likes. I mean, there is a risk that we could see this policy review chatter from the Bank of Japan also pick up further in Q1 as we get closer and closer to Kuroda's retirement. So keep an eye on that. There's abundant room, like I said, for the Japanese yen to recover. And going into 2023, I think remember to really call it a bottom in equities. You do need global growth getting close to a bottom. You need a bigger turn in sentiment and positioning, and you also need to see some excess liquidity. But we aren't there yet. Actually, we're just getting started on that path. So we still think it will get a lot worse than it before it gets better. So if you look at the US PMIs also from last week, December flash prints for the US, there are signs that economic momentum is deteriorating quite quickly. So while we still think consumer balance sheets are strong and a tight labor market in the US still will help them to avoid a deep recession. But there is no doubt that market concerns next year will move from inflation to economic slowdown. And that's why again we do expect the equities will start to price in that recession concern and potentially move lower because of that, despite the interest rate story being really absorbed by the markets now. So I mean, overall, I think we still favor being defensive on equities, and we favor balanced portfolios, possibly look for adding bonds for income generation as well as diversification into the next year. And on that note, actually, we also have another bonds webinar this week, tomorrow, that is, in which we will talk about why investing in bonds is making sense again, which bonds look favorable, and how to really navigate bonds on the Saxo platform as well. But again, I think maybe more specifically, I think, Redmond, it would be good to talk about what's happening in Tesla. Of course, that is catching everyone's eye these days.
Tesla's share price performance for sure is quite disappointing, and I think, I mean, but we never get more from receiving Twitter's news from Mr. Musk, and today actually there's another one. He's asking, should I step down as head of Twitter, and I will abide by the result of this poll. And so anyway, I mean, he's the shareholder of Tesla is quite has been concerned that Elon Musk has been spending too much time on Twitter and have not been spending the time on Tesla, and also yeah, I mean, that is one of the key concerns and troubling the share price of Tesla. And also on the news is saying there's report saying that Mr. Musk might be actually seeking the investor for his stake in on Twitter at the same price as he paid, and so good luck on that. And then I think he also said that he's lifting reverse course in the earlier decision to suspend the account of some of the journalists. I think that had a lot of pushback, and I think he had the survey, and then he said he followed the result of the survey, and then he's going to reinstate those accounts. So I think that would be still very volatile, I think, for Tesla's share price and going forward. And I think and also interesting to see whether Musk is maybe shifting more his energy back to Tesla from Twitter. I mean, that's all for me.
Yeah, I think that will be it from us today. Thanks for tuning in. And remember that this is our last Monday Market webinar for 2022. we will resume these sessions again on the 9th of January now. So keep that in your calendars, and have a good day, good week, everyone, and wishing you all a joyous festive season ahead. Bye.
Yeah. Okay. Bye bye.